rates have backed up to almost the all-time highs from this cycle, and yet we're 1,800 points higher on the S&P now than we were in October of 23.
Well, that's right, Kelly. And the market, especially technology, has shown that they can withstand the rise in rates. And by technology, I mean cash flowing elite technology, mega cap, large cap, the leading companies in a variety of industries, not the spec tech, which is where that phrase does have merit. But look, the interest rates have gone nowhere but up, and tech has been relatively resilient. And we heard earlier about productivity. Yeah, to some extent, companies are getting wiser in how they operate, but really it's this, they're seeking out new ways and they're using technology. So even in a slow growth economy, we think that technology spend, capital spend will remain. And that's another reason why we're resilient with our belief that technology is the best sector to be.
And that's an area that you're focused on as well, isn't it?
Yes, it is. And I think to some degree we're overrating and overplaying how much the new administration coming in is going to matter, but not in this area. We think that the M&A market is ripe. We think it's going to be sustained, if not supported, by the incoming administration. It's going to be good for economic efficiencies. It's going to be good for the stock market. We know from the prior run how important that is to the Trump administration. So we think mid-cap stocks are uniquely poised for this. The valuations are attractive. And then the dovetail on that are M&A related financial firms. And that's why we like the larger financial diversified capital markets play, because we do believe there's going to be an M&A boom, and it's going to be centered in those mid-cap companies across the board.